Hello everyone, hope you all had a Merry Christmas and an enjoyable holiday season over the past few days. Now, I want to provide an economic update on some data that was released last week, namely inflation and GDP. So of course, inflation is the most important data point these days, just for the central bank and their path of interest rate policy. So a recap, the central bank has hiked 7 times this year for a total of 4%. So we're currently sitting at 4.25% on an overnight rate for the Bank of Canada. Now, they've already indicated that they're nearing the end of their hiking cycle, meaning there might be 1 or 2 more interest rate hikes and then they're done. They've been quite aggressive to address inflation. So Wednesday last week, the data came out, it was at 6.8%. So slightly softer than the 6.9% of the previous print, but softer is good for us. We want this number to continue to trend lower. So, over the next few months, again, the forecast is that inflation will start to get closer to the upper bound 3%, which is what the central bank is looking for. So if we continue to see this number decline throughout the year, that's a good thing for us in terms of the central bank sees that their interest rate hikes are working and they kind of cool off and just relax and let the rate hikes kind of work its way through the economy. Now, on the GDP front, it came in slightly stronger than they were expecting at 0.1% for the month. Now, the expectation is that we're going to be in a recession early next year, which is 2 consecutive quarters of negative GDP growth. So we still haven't even had the first quarter. So hopefully, let's say by middle of next year or first quarter of next year at some point, we're starting to get into the recession. Why do I say hopefully? Because at the end of the day, this is what the central bank is trying to do. They're trying to aggressively raise rates to slow down domestic demand, slow down growth, push this economy into recession, which will help bring prices down. Okay, so it's sort of all that effect essentially. So what does this mean going forward? Okay, again, as the central bank is close to being done their hiking cycle, we're very much data dependent. The next Bank of Canada meeting is January 25th. Okay, so now we'll have another round before that hike of data, another inflation print. Employment will be the first week of January, for example, this coming Friday. So we're going to pay attention to all of that. So how is the story going to play out, or how do you follow this story? Okay, the 3 pillars again: inflation, GDP, and employment. If inflation continues to trend lower, if GDP starts to go lower and into negative territory, i.e. recession, and employment worsens, meaning unemployment rate goes up, jobs are lost, and more people are unemployed. From the central bank perspective, that is a good thing, which means because the economy is slowing. It means they won't have anything to do at that point. They won't need to keep hiking, okay? Conversely, if the opposite is true, meaning inflation kind of remains high or sticky is the term that they're using, so it's not coming down as quickly as they want. If the employment market remains tight, right? A lot of people are employed, there's a lot of jobs, there's not a lot of jobs out there, etc. And GDP, if the economy continues to grow, then the central bank will have to continue to be aggressive and will likely have a few more hikes in them. So that's why the data is very important to figure out what they may potentially do. Now, in terms of forecasts, if the economy continues to slow, then the central bank likely will not have much to do on the rate hike front. However, if we go into recession in 2023, depending on how severe and how long the recession lasts for, there's forecasts now for the back end of 2023 into 2024, the central bank will be in a interest rate cutting environment now, because obviously they're raising rates right now to slow our economy down. As we slow the economy down, inflation comes down, everything starts to get in check. But as we're coming out of recession, then the central bank is going to have to stimulate the economy again by cutting rates. So right now, forecasts will be back end of 2023 into 2024 rate cuts. So let's continue to follow the story. As always, I'm happy to sort of give a more detailed description of what's going on and have a more in-depth conversation with anyone who wants it. This is sort of just high level so we can continue to follow. And if you have any questions, as always, hit me up.